Hi, we just received a question from a client and I thought I would post it here on YouTube. The question was, could I consolidate all my investment loans into one? He had a number of different investment loans for different purposes, properties and so forth, and other investments. And he thought it was a bit cumbersome in terms of administration and managing all these loan accounts, and thought, let's just roll them all into one loan and make everything nice and simple and clean and so forth. And he asked us for our advice whether that was a good thing to do. Now, of course, I'd acknowledge that having multiple loan accounts and multiple offsets, it's messy and there's a lot going on. So I understand why this client wanted to do that, but absolutely you should never consolidate or have multiple purposes in one loan. There's a number of different reasons for that. You really need to be able to, well, firstly, the onus is on you, the taxpayer, to prove to the ATO that your deductions are legitimate. And the only way you can do that is by making sure you've got a really clear and clean audit trail between here is the asset that I purchased and here is the loan that I used to either partly fund or fully fund that purchase. And so therefore you should separate loans by investment and purpose. So purpose, whether it's tax deductible or non-deductible, never mix those two in one account. And by asset is important too, so that you can clearly articulate this part of the debt is attributable to that asset. Now, why is it important? Well, there's a number of different reasons that it's important. Firstly, flexibility to repay certain parts of debt that relate to certain assets. The ATO says that if you make a repayment into a loan that is for multiple purposes, you have to apportion that repayment across all purposes. So, for example, let's say that I have a home loan for 500,000 and I redraw 50,000 to invest in the share market. And so that 50,000 normally would be tax deductible. If I get a bonus at work and I want to repay $50,000, the ATO would say that that repayment has to be apportioned across both the deductible and non-deductible purpose, whereas that doesn't make sense. I would want to obviously reduce my home loan first before I reduced any investment debt. Separating it by property and purpose or investment and purpose, again, will allow you to prove the deduction. And also when you go and sell the asset, it will also allow you to prove which loan that you had to repay and which loans can you retain, because they still relate to existing or retaining investments that you're retaining. And interest deductions will be as an investor that borrows to invest, interest deductions will be your most valuable deductions by far. Normally across property deductions, interest is 80-90% of it. And so you never want to compromise the deductibility of that interest. You want to make sure that you've got a clear, clean, nice audit trail of what debt relates to what asset, and therefore what interest is tax deductible because it relates to that particular asset. So always separate loans by purpose and by investment, and always try and avoid cross securitization. I'll include a link in this video in the description to explain a little bit more around cross securitization and why it's important to avoid it. But I thought it was a great question and I thought I'd post it here. Cheers.